Welcome to another episode of Incentive Cry from the House of JE, where we break down Nigerian tax laws and explain what they mean for businesses and ordinary Nigerians. Today, we are discussing a VAT rule that many businesses overlook, the self-charge VAT mechanism under the Nigerian Tax Act 2025. Most people think VAT is always collected and remitted by the seller, but under the new law, there are situations where the responsibility shifts to the buyer. That's right. Self-charge VAT, also known as self-accounting for VAT, is a system where the recipient of a taxable supply becomes responsible for calculating and remitting VAT directly to the tax authority. This provision is contained in Section 155 of the Nigerian Tax Act and represents an important compliance responsibility for businesses. My name is Chineye Confidence.
And I am Faith Smart. One of the circumstances where this rule applies is when a business receives an invoice that does not include VAT. The absence of VAT on an invoice does not automatically mean that no VAT is due. The law may require the recipient to account for that tax themselves. This means businesses need to review every invoice they receive carefully. 1. Identify invoices that do not contain VAT. 2. Determine whether self-charge rules apply. 3. Calculate and remit the VAT before the statutory deadline. 4. Keep proper records and documentation. The law also sets a clear deadline for compliance. Any VAT that is self-accounted for must be remitted to the tax authorities on or before the 14th day of the month, immediately following the transaction. Missing this deadline could expose businesses to penalties and unnecessary compliance issues.
The self-charge principle also extends beyond local transaction under Section 151. When a non-resident company supplies taxable goods or services from outside Nigeria to a person in Nigeria, the Nigerian recipient is required to withhold and remit the VAT directly to the service. This is often referred to internationally as the reverse charge mechanism. This ensures that VAT is collected even when the supplier is not physically present in Nigeria. The objective behind these provisions is straightforward. The government wants to ensure that the taxable transactions do not escape the VAT net simply because a supplier failed to charge VAT or because the supplier operates outside Nigeria. The responsibility therefore shifts to the person receiving the goods or services.
For businesses, this means VAT compliance is no longer limited to the tax they collect from customers. It now includes reviewing incoming invoices, identifying transactions that may fall under the self-charge mechanism, and ensuring that the appropriate VAT is remitted on time. Proper record keeping is also essential. Businesses should maintain details of the supplier, the invoice, the amount involved, and the VAT remitted. This record became important during tax audits and demonstrates compliance with the law.
So the major lesson from today's episode is simple. If you receive an invoice without VAT, don't assume there is no tax obligation. If you receive services from a non-resident supplier, don't assume the supplier will account for the VAT. The law has placed that responsibility on you.
Self-charge VAT is a reminder that tax compliance is everyone's responsibility. Understanding these rules help businesses avoid penalties, improve their tax processes, and stay ahead of changing regulations. Thank you for joining us till the end of this incentive cry. Stay informed, stay compliant, and keep learning about the policies shaping Nigeria's tax system. See you on the next episode of Incentive Cry. Bye.